All right, today we are diving into the really fascinating world of traders who try to do something that, well, it sounds a whole lot like mind reading, trying to predict market behavior. And that's the million-dollar question, isn't it? Can we actually find clues about where the market is headed next just by looking at where it's already been? This, right here, is the central idea behind what we call technical analysis. Okay, so let's get into it. We're going to start by decoding what technical analysis really is, and more importantly, how its followers see the market. So, at its absolute core, this is what we're talking about. Forget the company earnings reports for a sec, forget the big economic news. Technical analysts believe that pretty much everything you need to know is right there on the price chart. It's the history of the battle between buyers and sellers, all laid out visually. This analogy just makes the whole idea click. It's brilliant. Imagine that price chart is just a trail of footprints. Every single move, up or down, leaves a mark. And the analysts? Well, they're the trackers, trying to read that trail to figure out the next step. And here's another great way to think about it. The chart is like a car's rearview mirror. Now, when you're driving, you don't stare at it, right? Of course not. But you glance at it constantly to understand what's happening behind you so you can navigate what's ahead. It's the exact same idea here. So to really get this approach, you have to understand its foundation, which is built on three core ideas. Think of them as the fundamental rules for reading this special kind of map. This is the big one. The idea is that every single piece of information that could possibly affect a stock's price, we're talking news, data, politics, even just plain old investor fear or excitement, is already reflected or baked into its current price. This is just the perfect way to put it. A thermometer tells you the temperature. It doesn't tell you why it's hot or cold. A technical trader looks at the price and basically says, that's the result of everything. They focus on the what, the price itself, not the thousands of potential whys that got it there. Okay, on to the second core belief. This is the idea that price movements are not totally random. It's not just chaos. Instead, prices tend to move in a general direction for a certain amount of time. And that direction, well, that's what traders call a trend. Let's take a look at this slide to see exactly what that means. Over on the left, you've got a classic uptrend. See how the price makes a new high, pulls back a little, then makes an even higher high? These are higher highs and higher lows. It's a clear sign that the buyers are in control. And on the right, you guessed it, the exact opposite. A downtrend with lower lows and lower highs, telling you the sellers are running the show. But what happens when no one's really in control? Well, you get this third state, a sideways market. Look at this chart. The price isn't really going up or down. It's just bouncing. It's hitting a ceiling, which we call resistance, and a floor, which we call support. This is basically market indecision, a stalemate between the buyers and sellers. I absolutely love this analogy. An uptrend is the tide coming in. A downtrend is the tide going out. And a sideways market, that's just calm water. The whole goal for a technical trader is to figure out which way the tide is moving and just ride it. You don't want to be the person trying to swim against a strong current. And that brings us to the final pillar. It's the idea that history tends to repeat itself. And the reason for this is actually fascinatingly simple. It's all about us. It's about human psychology. So here's the logic, right? Markets are just made up of people. And people, when we're faced with similar situations, tend to react in predictable ways. Why? Because we're driven by these timeless emotions: fear, greed, hope, panic. And since human nature doesn't really change, the chart patterns that result from these big emotions, they tend to show up again and again and again. Wow, this one really paints a picture, doesn't it? That collective human reaction to a threat, pure panic, it's the same today as it was a century ago. It doesn't matter what technology we have. Technical analysts believe the very same thing is true for markets. The patterns of fear and greed you can see on a chart from the 1920s might just show up again next week. Okay, so now that we have the theory down, let's put it into practice. To really get a handle on technical analysis, it's super helpful to see how it compares to another major approach to the markets. So here is the key difference, laid out side by side. Technical analysis, as we've seen, is all about the chart. It's trying to figure out when to buy or sell. It asks, who's winning the fight right now, buyers or sellers? Fundamental analysis, on the other hand, digs into the company's health, its profits, its debt. It's trying to figure out what to buy. It asks, is this a good, valuable company? And honestly, A lot of pros use a little bit of both. And this difference in approach leads us to a difference in mindset. An investor is usually playing the long game. They're using fundamental analysis to find a great business and hold on for years, maybe even decades. A speculator, who often leans heavily on technical analysis, is more interested in the short-term dance of the price. They're trying to profit from the swings. Totally different goals, totally different strategies. All right, we have covered a ton of ground here. So let's boil it all down to the most important principles, the key things you should walk away with. So let's just recap the big ideas. First, the price is king. It reflects all known information. Second, markets move in trends, up, down, or sideways. And third, because human emotions like fear and greed are constant, history tends to repeat itself in predictable patterns. For a technical trader, all of this makes the price chart their single most important tool. And that really leaves us with one final big question to think about. If human psychology, our collective fear and greed, never really changes, does that mean the patterns these emotions create on a chart are truly predictable? It's the central question that keeps traders glued to their screens day in and day out. Something to think about, isn't it?